By the end of 2022, consumer confidence and real estate consumer confidence was basically near all-time lows. It registered in around the third lowest of all time. This is happening at a time when debt insolvency numbers are also climbing. But then, of course, we also have a very recent inflation print, and we've got very strong job numbers. So are we actually nearing the bottom of a cycle, or do we have more rate hikes coming later this month that are going to send this thing further down its current trend? We're going to get into both scenarios in this episode, plus share some pretty staggering Toronto and Calgary numbers with you, and of course, talk to you about what we feel is coming in the next few months here, so stick around for that.
Hi guys, Ryan Dash here along with my co-host Dan Wertel. We are with eXp Realty and we create videos like this every single week to give you all the education you guys need to navigate this very tricky marketplace. If you would like to get in touch with us and learn more about different communities related to the Vancouver marketplace, book a direct meeting with us through our Calendly link in the link below. You'll find it there. And please make sure you hit the subscribe button, the like button, and ring that bell so you guys don't miss any of the upcoming videos that keep your finger on the pulse of Vancouver real estate.
Thank you for that, Ryan. So consumer confidence. 1 year ago, the wealth effect was in full effect and people were feeling, wealthy. And they were making a lot of purchases. And what a difference a year makes, and what a difference 400 basis point interest rate hikes make. Because a recent survey was done that really kind of speaks to the current sentiment out there. And this was done by Manulife. They did what they call a debt survey. And this is all across Canada. And what they found was essentially that 1 in 4 mortgage holders right now say they'll be forced to sell their house if rates increase much further. That's a big number. That's 25%.
Mm-hmm. Yeah.
2 out of 3, we're talking 66% here, say that they are worried about making their mortgage payments. And of course, how much they owe on those current mortgages. Because as we know, about 90% of people will purchase the absolute highest price home they can technically afford. Now, maybe they're looking back at current rates and saying, that's a big number. Okay, probably especially here in here in Vancouver, and of course in Toronto as well. Now, 1 in 5 people, homeowners, believe they can no longer afford the house they own. Again, a staggering number. This is 20%. And again, this is not, let's say, verified by financial data. This is more sentiment, okay? And so, again, 1 year ago, they felt very different. But of course, we are in a very different environment, largely driven by interest rates. Now, 85% of people that are renewing their mortgage in the next 12 months are very concerned by what that means to their finances. Okay, very, very warranted statement there. Now, home prices, of course, are well off the peak. Depends where you are, but let's just go nationally to make it easy. Nationally, I think we're down 16, 17% from the peak. Still, 81% of Canadians feel that there is still a housing affordability crisis. Of course, falling prices have not met the current interest rate hikes and, of course, what the mortgage payments equal. And lastly, 64% of the people that were surveyed said that they wanted to buy a home but could not afford one in 2022. So yes, there you have it. That's kind of the sentiment from a recent poll, and it's very understandable. Houses are expensive. Rate hikes were tremendous, the highest in recent history. So of course, people are feeling the pinch. Now, that survey was, of course, done at the end of last year, and here we are in January. We're recording this on Thursday, the 12th, where this morning the U.S. inflation print came out, and it now hit 6.5%. So what's significant about that? Obviously, still a very elevated number, but down a whole 0.6% from last month's print at 7.1. Now, that's the largest month-over-month drop that it has seen since July of 2022. This drop was led largely by fuel prices and is the 6th monthly decline in a row. And we are now back to October 2021 inflation numbers. Okay, so we're at a 14-month low there. So that is definitely starting to turn the cycle a little bit, if you will. And that was definitely noticed in the stock market today, where after the print, the stock market ripped and definitely ended the day on a green note. I will add that though, that is general inflation, core inflation actually increased by 0.3% and is now sitting at 5.7. It has been much more stubborn and has kind of bounced across the top here for 3-4 months now. But that is kind of what people are feeling. Ryan, why don't you talk a little bit about the sort of economy now as well?
Yeah, just before I touch on that, Dan, you bring us some really interesting points. And, generally speaking, the government tends to react when they hear a lot of noise in the marketplace. And I guess my question really is this enough noise for the bank to really start thinking about what their next moves are going to be? I think we're getting to that precipice. We're not there yet, but we're getting close. And that being said, it's great to see that U.S. inflation data has come down from 7.1 to 6.5. However, much like you've said, the affordability element, at least here in Vancouver and probably in Toronto, hasn't really changed. I mean, prices have come down, but the cost of borrowing has gone up by more than prices have come down. So, things in terms of how much money is going out for people, that really hasn't changed too much, unfortunately. And then as we get into the sentiment within the economy here, this is a staggering number. 87% of people believe we are in or will soon enter a recession. If you're in anything connected to the housing market, you're in a recession. I can tell you that. But generally speaking, outside of that, it's not just our industry that's getting hurt now. We're seeing it across all industries, including and especially considering construction. We'll get into that in a little bit, though. 48% of people feel overwhelmed by their financial situation. And I can completely understand that. Half shared that their spending is outpacing their income. When you have a wealth effect like we had over the last 2 years, and then you suddenly and quickly turn that off, that change is very difficult for people to absorb. Hence why their spending is likely outpacing their income. 54% think inflation will take at least 2 years to return to normal. I don't know. If we keep having, prints like we had today, it'll do that before then. So we'll see. We'll see where we go from there. And then, Dan, why don't we get into some debt here?
Yeah, definitely. So I think I also just want to add here as well, we wanted to touch on the jobs numbers because that's kind of keeping things elevated here too. And is technically keeping, if you ask certain people how they measure recessions, strong job numbers, do not mean that we're in a recession, right? You need to have job losses. And so we had 104,000 jobs supposedly added in Canada just last month. The estimate was 5,000. So Whoa. Definitely some things were crossed there that did not align. Again, some people don't believe the data is all that accurate, but again, to be that far off the mark is pretty astounding. But either way, let's call it 104,000 for argument's sake right now. That is certainly keeping not only people spending just afloat, but adding a little bit more confidence, right? Because this print just came in again last week. Mm-hmm. So while we're ending the year on a very quote unquote sour note, strong jobs and lowering inflation may start to turn people's sentiment around. But yes, kind of like what Ryan alluded to earlier here as well, that people's spending is outpacing their income because yes, when things were good, when there was that free helicopter money dropping from the skies for 2 years from our government, people felt wealthy and were out buying things and stuff. And so a lot of people, when it does shift this quick, they want to maintain that lifestyle, understandably. And so they're having to dip into things like savings and now credit cards and lines of credit to maintain that lifestyle. And it's obviously you have to pivot when your financial
circumstances.
Yeah, when your circumstances change as well. So insolvencies hit an all-time low here back in around April, May of 2020. That's when they hit the bottom. That's when people were the most solvent. Now, since then, we have, or just year over year, insolvencies are up about 16%. And so we're now the highest that we've been since March of 2020. So essentially just prior, or kind of just as the pandemic lockdowns were happening. Understandably, this upward trend will continue. It is important to note, though, we're still about a solid 20-25% lower than the averages that we saw prior to the pandemic. So in that sense, overall insolvencies are stronger. Mortgage insolvencies are actually sitting at an all-time low right now, but we touched on that last week. And don't forget that data is about 180 days. Let's call it 6 months lagging. But as of 6 months ago, mortgage insolvencies, all-time low. Delinquencies, sorry, let me correct myself. Either way, expect upward trend in these insolvencies to happen, or to continue rather. Will they come back to where they were pre-pandemic? Likely. at current rate, that's going to take another, 9 to 12 months.
Mm-hmm. Yeah. And when we actually get into outside of consumer debt and get into business debt, this is where it kind of gets a little bit more scary. Business insolvencies are up 58% year over year. Their debt costs have obviously soared with interest rates. Even these companies, they benefited from cash from the government, but if they weren't able to turn that cash into a whole lot more cash, you end up with 58% year over year debt insolvency that have risen. This is the highest since 2019, led by a 74% increase in the construction sector. You got to remember, if homes aren't being built and sold, these companies can't operate. And like we talked about in a number of podcasts, especially if those companies are carrying inventory, a lot of their available cash flow, a lot of their overhead is going to be servicing that particular debt, which is why we thought they were going to get hurt the most. And lo and behold, here we are seeing that in terms of businesses. Less homes being built. Interest rates are driving this. This we know, right? But get this, business rates are up 400 basis points, the highest since 2001. That's scary. Businesses can't afford to do that. Most businesses run on very tight margins. So if you see that kind of cost increase, it could be game over for your business. Effective rates for businesses are substantially above those for households, and this, Dan, is the first time since 2009. And while most are looking at consumer data, there may be a big surprise coming from losses in the commercial lending sector throughout Canada. This is getting hit with the severe economic downturn. So, obviously, like we talked about before, that also means opportunity for people who have got cash, for people who aren't in that market for lending. So, it's blood on the streets for one side and opportunity for others, unfortunately. And such is the case when we go through a massive rate hike that happened in a record period of time.
It's those kind of numbers that make people definitely question the 104 new job creation or new jobs that happened just last month. This is something that's going to be closely watched here for the next couple of months, because we know the layoff stories are always getting the headlines more so than the job creation headlines. But again, those numbers are just as real. So realistically here, it's very kind of polarizing what's happening with the jobs data, but we're going to follow this either way. Okay, so now we want to get into some of the Toronto data, because it's pretty fascinating, and they're just seeing a completely different market now than we're seeing here in Vancouver. So year over year, they saw their sales drop dramatically, even more so than we are here. Sales are down 48% year over year, and this is led by condos, which saw a 55% sales drop year over year. Now, similar to Vancouver, the new listings are not materializing. New listings are down 21% from this time last year, and that's actually, Toronto just came out of having the lowest Q4 listings that they've had in 15 years.
Wow.
For reference, there's an additional 1 million people living in Toronto since the last 15 years. So even though there's another million people living there, they are experiencing a 15-year low in new listings. Wow. Even with that said, though, this is a real differentiator. Year over year, active listings total are up 170% in Toronto. Now, compare that to Vancouver, we're up 24%. And that is a massive difference. And that's what's essentially keeping the market here, I can't say afloat, but falling at a much lower rate than Toronto is. For example, home prices dropped 0.8% just last month in Toronto, but they're down 9% year over year. And compare that to Vancouver's 3.3%. Big difference. And this number is definitely worth paying attention to. So from the peak, Toronto's down 19%, with their median price down 26%.
Holy
Again,
cow.
Massive number. And so, that peak was March, April kind of thing. Vancouver, 13% from the peak, but our median is also 13%. So Toronto's median price is gone down twice as much as Vancouver's has. Big number.
Wow.
And this is at a time too. So we are at a point in Toronto where they're going to have some interesting headwinds come 2023. And what I mean by that is they actually have a record number of condominium projects completing next year, to the tune of about 32,000 new condos are completing next year. People have to get mortgages for those condos for the most part, and they're going to have to qualify at the current rate, which can have a high 7 or even an 8 in front of it. So much harder to qualify than when they likely originally purchase it. Now, hopefully they were savvy and they worked with a good agent who told them they can get a 2, 3, sometimes even 4-year rate guarantee on their mortgage. But those who didn't are going to have to qualify at today's rates, which is going to be a bit harder. Now, for reference, the previous record of new condo completions in the upcoming year was back in 2020, where they had 22,000. So there's a full 50% more condos completing than the previous record this year. And again, why is this significant? Why might this be headwinds? Condo ownership, the average amount it cost to buy and hold a condo in 2022, at least near the end of Q3 there, was about $3,500 a month. So we're talking about the mortgage and all the expenses, your strata, your property taxes, insurance, etc. Whereas the rent was $2,733 on average. That means the average owner, if you were an investor and you were renting out your condo in Toronto, you were backwards. You were paying into your investment every month to the tune of $775. That's a big amount. And right now, this is also exemplified because we have even higher rates coming up and we've got rents turning over, especially in Toronto, or rolling over rather, meaning they're starting to come down. As an investor, you're looking at that going, okay, I got to close on this property and there's a whole bunch more hitting the market and it's very expensive to qualify for. And my mortgage payments are high and rents are coming down. It's not a very attractive marketplace. So you can imagine the investor segment of the marketplace is likely going to pull back tremendously in the Toronto area in 2023. So with higher mortgage rates, negative cash flow, investors are obviously exiting. Some of them might not even close. And here's the thing too, they may walk away from deposits. Yes, there's a whole legal issue they may have to look at, but it's going to potentially be a pretty tumultuous year for Toronto condos.
Yeah, that's fascinating, that whole story. I mean, with a population increase of 1 million, you'd think 32,000 condos would be a welcome reprieve. I'm assuming we're going to see, that impact the average rent. Certainly, their new listings, clearly it's not materializing, but that might change with a huge amount of condos that flood the market here in 2023. We'll see. Like you said, if some of them were savvy enough to lock up rates prior to completion, then they might get through it. Generally speaking, that's quite a significant amount of inventory. Let's touch on Calgary here. Calgary, I mean, Alberta, generally speaking, has been flat for a decade. It hasn't done much. As soon as oil went down to $30 a barrel, it's had trouble staying afloat and getting back up ever since. But now, 10 years on, it's outperforming the rest of the country, right? 25% of those 104,000 new jobs were in Alberta. Now, that shouldn't really come as a huge surprise when you consider the affordability side of what Alberta has to offer, including the wages that they're paying. So, the lifestyle outside of negative 40 degree winters, the quality of life is going to be quite decent based on income to available jobs and the cost of living, right? As such, prices are up 7.8% year over year, but the rate of change is falling rapidly. So we'll see if it maintains.
Okay. So what's happening next, and how does all this information affect Vancouver real estate going forward? Well, a couple key dates coming up, of course. We just had the U.S. inflation come off today, 0.6%. Canada gives us their numbers on the 17th, which is just early next week. Will it emulate the States like it kind of does for so many prints? Likely, we might see a whole half point. We don't know yet, of course, but if it does, how is that going to affect the interest rate announcement, which is coming on January the 25th? Because there's going to be a lot of eyes on there. And of course, TIFF is going to have two polarizing views here, right? We've got really strong job market, which means more rate hikes, but then we've got potentially inflation coming down. And like we alluded to earlier, the people who own homes and the struggles that they're having with paying for those homes is getting louder. And while the Bank of Canada loves to say they don't bend to public pressure, at the end of the day, it's unavoidable. They're going to be hearing these similar type of stats and data and whatnot. So going to be very interesting on the 25th. We're obviously going to watch that and see what happens. If it's the markets are pricing in a 25-point hike. 50, I can't see it. It's totally possible. Nobody knows. They don't give us any hints in advance, really. But I think that I can't see the marketplace being able to handle that right now. So 25 points is most likely. It could happen could go either way. As much as I want it to be zero, I don't think it will be, but zero would send a very strong message to the marketplace. And then let's keep in mind here too, the next interest rate announcement is not until March. So we're going to have about two and a half months here before the next one. So lots can happen between now and then, but with all these new jobs here too, we're starting to have what I would call early potential indicators of a bottom. And I'm not calling it the bottom. I'm not even giving a horizon as to when the bottom is, but we're seeing things start to shift.
If you don't mind, Dan, I kind of want to play out this rate hike scenario for a second here. So let's say, for example, on the 25th, what is your perspective on, yes, I agree. If they don't raise or they maintain, I think it sends a message to the marketplace. What if they actually raise by 0.5 to really push inflation back the other way? If you will, it's like, more pain up front for a quicker recovery on the long term. Do you think we'll see that, or do you think we're too close to a recession for them to do that? Or are they just going to maintain likely that 0.25 and then hold and see where we go? I think there's maybe a conversation piece for both, but
I look to the business debt segment that you just talked about. When you've got businesses struggling that strong, and that's what's keeping our economy alive, they're so indebted and they're feeling the pinch so much, and we're seeing the layoffs that they're going to be, that segment of the market is going to be quite loud as well. And I don't think they want to put that many businesses out of business, which something like a 0.5 would get pretty close to doing. And again, let's remember our homeowner numbers. They're 2/3 are on the brink. And a quarter point, maybe you can survive that short term. You start going 0.5 in this environment, and you're going to put people almost out of their homes. So it's a very precarious position right now. I don't see 0.5 happening myself. I'm not the governor. I don't control this, but that's what I'm feeling.
Well, the reason I say that is because if they raise by 0.5, then there is an argument for cutting rates sooner than if they raise by 0.25. So it's like a smaller window of pain to really drive that inflation down and then pivot quick. But I don't know if we'll see that.
Right. Yeah. And of course, a lot of that is going to stem on what happens on the 17th here. If we see inflation super stubborn, go flat or 0.1, the 0.5 suddenly becomes a lot more potentially possible. If it drops similar to the States, 0.5, 0.6, 0.7, then things are quote unquote working. And now we're on a trajectory where we could be back in the 2 to 3 target range within 9 months or so, which I think they would feel very encouraged by. But hey, let's wait and see what that does. And we'll report on it next week.
It's really interesting. Just the last piece here. When you've got everybody in one camp, right? Like everybody's terrified. Everything's hurting right now. And everybody is calling for, more prices to come down and so on and so forth. I get a little hesitant when everybody is in one camp and jumping in that one camp. There's definitely an argument for a contrarian perspective. And, when everybody's over here, what does that mean when you've got opportunity on the other side? So I just wanted to bring that up because it could be, everyone wants a particular storyline to take place, and markets typically take the path of most pain. So I just, if everyone's in the camp of, I don't want to spend any more money. And yet, what were we calling for 5,000 new jobs? We ended up with 104,000, right? It's interesting.
It's very common within this cycle that the media will only sort of have one focus at the peak or at the bottom. So let's keep in mind, when every headline back in February, March, even April was talking about excessive and exuberant housing prices, they had already missed the peak. It was already on its way of rolling over and starting to head back down. And so not that they're the last to find out, because the media is getting, I find, a lot more timely now. But again, you're absolutely right, because if everyone is in one camp, it's shocking how cyclical this is, meaning that things are actually starting to go the other way. And there's no doubt right now, the negative camp or the downward camp or the stressed out camp is the loudest and the most predominant, and the one we're hearing about the most. But what does that mean? That means that things are the data is saying a little bit otherwise right now.
Yeah. And I mean, if everyone's calling for inflation to hit, the 2 to 3% by mid 2024, or say end of 2024, then, we're going to miss the opportunity of it actually potentially going lower sooner. Again, there's a lot of economic fundamentals that need to take place for that to happen. But I just caution everybody of just don't be all in on one side. You've got to give credence to what could happen too. And I think that's important.
Great place to end it. Thanks as always for watching and listening. We are excited to come back next Saturday morning with a new episode. And of course, next week we will be unpacking what happened in our Canadian inflation frame. So thanks as always, and have a great day.